you're not buying used cars, inflation for you is much worse. And the yen carry trade is not over. We just saw the yen collapse by 2 full handles from about 147 to 149 in a few minutes. And this is on the resignation of the Japanese Prime Minister, who is resigning because inflation is too high in the country and people are suffering. The Japanese, they're not reproducing and they're spending too much money and they're running out of people. So all in all, a failure by the Japanese Prime Minister, who is not running again for office. Related note, people have been asking me, well, if the Great Taking is real, I believe it could be real, and then what's the point of owning any gold or silver mining shares if they're all going to be taken away from you? I don't think they will, but a safer way to hold gold and silver mining shares like Fortuna would be to hold them through a broker that you trust, such as Schiff, who I trust will not forcibly take away my shares if I own them through him. And so if you want to take away a few layers of kleptomania that could lead to a great taking, Schiff's mutual fund is probably a safer way than Robinhood to own your mining shares. And with that, you can own a nice chunk of Fortuna Mining. Symbol FSM.
Can you believe that to match gold's 1980 peak in today's dollars, the price would need to soar to an incredible $60,000 per ounce? That's not just a big number, it's 2,500 times 24. And it speaks volumes about the economic forces at play. In this video, Rafi Farber uncovers the shocking implications of this figure, especially as we stand on the brink of what could be a severe recession. But that's not all. There's also the looming specter of gold confiscation, a scenario that could have devastating consequence for anyone holding onto physical gold as a safe haven. This isn't just a distant possibility. It's a real and present danger that could reshape the financial landscape. Understanding these dynamics isn't just interesting, it's absolutely crucial for anyone who wants to protect their wealth in these uncertain times. Rafi breaks down what these numbers really mean, how the historical context plays into today's economic environment, and what you need to do to safeguard your assets.
Let's continue with this week's slides. This is the silver report after all, so we will begin with silver. I have here a chart going back to the 2011 silver top relative to the CRB, so silver relative to the CRB. We hit here, it looks like, major resistance. The only time we broke through this resistance at, what is this number, 0.1145 or something like that. We've hit this resistance many times before. The only time we broke above it is in the 2011 top at 50, and during the lockdown phase over here, which we hit an all-time high. Other than those exceptions, this is the major resistance, and we're coming onto it for a fourth or fifth time, depending on how you count it. And now we are coiling off the 200-week moving average. I do think we're going to break through this resistance finally, not for any lockdown reason or for any spectacular bull top reason like we had in 2011. I just think silver will continue to climb until it catapults in a monetary crisis, which is coming up in the next few months, in my opinion. But let's move to the gold to stocks ratio. We see here that we have a major triangle that has formed since 2000 here. The lower this goes, the higher gold relative to stocks, the lower stocks relative to gold. And we can see here that stocks have been falling relative to gold pretty spectacularly since 2000, 1999, 2000. And we're going to break out of this triangle, I think, lower. And we should head past the low here, which is somewhere between 1 and 0. I don't know exactly where, but we are going back there. This is a longer term chart of this thing over here. This is the same chart going back to 1900. No, not exactly the same. This is the S&P 500 and this is the Dow, but it's basically the same chart. I think I have the S&P in the next slide, so you'll see that too. You can see here, this I call the bikini top of doom for stocks because why not? This looks like a bikini top or glasses, but bikini top just sounds better. I know they're not even, but you know, they never really are perfectly. So we have here, it looks like a triple move where we had lower highs going in the 1960s and 1970s of the Dow relative to gold, and then we had a major top here in 2000 that we've never even gotten close to, and now we have like an echo bubble of the same sort of pattern of lower highs, one here, one here, one here, and it's continuing to fall. So I do expect that we will get to the 1980 lows here, which are reflected in 1931 lows over here, slightly lower than that. but this ratio is headed down. I think this top here is not going to be repeated. It means that stocks are going to fall hard relative to gold and harder relative to silver, though silver will catch up at the end, as it always does. This is the S&P 500 relative to gold. Sorry. So the lower this goes, the lower the S&P 500 goes relative to gold. And you can see a very similar chart here of lower highs and head and shoulders. And this is also a bikini of doom. And now, I said in the introduction that I would explain why I think that the end of the year is still ripe for the final financial crisis, which will result in the final printing round, which will be bigger than 2020, which was bigger than 2008, which is bigger than 2001, etc. So here we have a chart from a friend of mine, a subscriber to the Endgame Investor on Substack, Dr. John Gideon Hartnett, who Chris has also spoken to. He's a physicist and a very wise man. It says here, I titled it, even if QT stops completely, that takes us to February 2025. I'll explain this chart in a second here. So this curve here is a double exponential. What Dr. John Gideon Hartnett did was he plotted Fed liabilities going all the way back to 1913. This is one section of that graph, and found that the liabilities had to plot a double exponential curve. This is number 2 here, as you see. And every time that the Fed falls below the curve a certain amount, you have a financial crisis. And we find that point to be, in 2019 during the apocalypse, 36% below the double exponential curve. And the Fed went back above the double exponential curve during the 2020 printing round. And when it went below it again, there was a minor regional banking crisis. And now we're headed towards the 36% below crisis line over here. And had QE, this is QT, sorry, QT, this was the line of the trajectory of QT from the time post-regional banking bailout until now. If it had continued on the line that it did, you can see QT slows down slightly over here. Had it continued at the rate it had gone post-regional banking bailout, then we would have hit the 36% below crisis line at August 31st, 2024. And now we're slightly below that rate, so it's going to stretch out. And what I did was I added the calculation that even assuming QT completely stops, meaning the amount of liabilities stays the same on the Fed's balance sheet, or the assets liabilities, same thing, we will only be able to stretch out to about January, February 2025 until we hit the next crisis. Why? Because the double exponential continues to move higher and higher, and the Fed's liabilities must match that. And if they stay stable, we only have a few months left until the next crisis anyway, even if QT completely stops. So this is what Dr. Hartnett wrote over here. You can check out the full post at this URL, pause it here, and check it out. And now this is another way to measure the same thing, the 36% below the curve mark, which has triggered crisis in the past. This is, I've shown this before, repos as a percentage of reserves, and the repo volume keeps rising every week. We are now at an average of about 2.1 trillion for the week, and next week it should be even higher. And reserves are steady, but even if they are steady, if repos keep rising, then this ratio keeps rising, as it has. I think we're at 64% now. And if you extrapolate this line out, we only have until about December, January 2025 until we hit the crisis level of 86-87%, as we did during the apocalypse over here. So same sort of time frame, late 2024 for the next crisis, when we hit 87% on this, which is the same as 36% below the curve of Fed liabilities on the other chart. It's all triangulating to the similar time frame. This is from Daniel Oliver's latest research that you can find at mermccann.com, and he is my favorite gold and silver analyst, as you would know if you've been following me for any amount of time. So what Oliver says here is that the 70s stagflation was actually worse for stocks than the 1930s, and actually as good for gold, but in a different way. The 1920s bubble was simply a credit bubble. There was no monetary debasement. The S&P 500 crashed 88% in nominal terms from peak to trough. That's 1929 to 1932. In the 1970s, the S&P 500 from its peak to 1967 to its trough in 1980 fell only 14% nominal terms, but 94% in terms of gold, which is much worse than it fell in terms of dollars, which is also in terms of gold in 1930s. If we are living through a repeat of the 1970s and the parallels seem so perfect, we should not expect a cataclysmic collapse in the stock market. Despite the ridiculous valuations, stocks would instead lurch higher and lower within a trading range for the next decade ending in roughly the same nominal price but worth 90% less. Gold, on the other hand, will reveal the carnage. It rose 24-fold from 1971 to 1980. The way we look at it, gold went from being 12% of the Fed's balance sheet to 133% in the final dollar panic. The gold currently represents just 8.8% of the Fed's assets, so it would need to jump to 36% to 3,300 just to get to the 1970 low. So if we're talking about a 24-fold increase, as we saw in the 1970s, a 24-fold increase from now, because we were below where the low was in the 1970s, would be what, 2,500 times 24? I don't even know what that is. I can't really do the math so quickly, but do it yourself. 2,500 times 24. That's the high we need to get to just to reach the 1980 high in today's terms.
Thanks for sticking with us through this deep dive into gold's potential future value and the critical economic forces at play. As we've seen, understanding the historical context and the numbers behind it is essential, especially in these uncertain times. Whether it's the looming threat of a recession, the possibility of gold confiscation, or just staying informed on how to protect your wealth, this is information you can't afford to ignore. If you found this video insightful, make sure to give it a thumbs up, share it with others who need to hear this, and don't forget to subscribe to the channel.